Welcome to our State of the Markets update for January of 2025. We're excited to walk through the economic and market conditions that we've seen in 2024 and a preview of what we see happening ahead in 2025. Let's dive right in and talk about 2024. The stock market did well. You can see the U.S. stock market up almost 24% for the year. International markets had lagged a little bit through the course of the year, and then in the fourth quarter dropped substantially. We'll talk about that in just a moment. The international stock market up 5.3%. That would be developed market country companies. You can see the emerging markets up 8.1%. Far better, all three of those indexes than fixed income. You can see fixed income in the aggregate U.S. index up 1.3%. U.S. Treasuries up even less, up just 0.6%. Municipal bonds as a whole up 1.1%, I should say. And global reinsurance up just over 17%. So another strong performer over the course of 2024. Now, the fourth quarter was more of a varied story. The stock market in the U.S. was up about 2.5%, as you can see there, but international and emerging market companies in particular were down, especially after the U.S. election. There was some concern, I think, that the tariffs potentially would cut into the rates of return that that international companies, I should say, would provide to investors. You can see at the same time that Treasury yields increased in the U.S., and that pushed down returns in the U.S. aggregate bond market, down about 3% in both the aggregate fixed income market and U.S. Treasuries. Municipals didn't go down quite so much, down 1.2%. You can see, again, global reinsurance up 3.8%. That Swiss Re index performed well in the fourth quarter. Now, diving a little bit deeper into U.S. stock returns over the course of last year, large companies led the way, and particularly large growth companies. Really, the rates of return were concentrated in those large tech companies, up 33.4%, those large growth companies. You can see even small cap and large value companies did well. They were up double digits, but not up as much as those large growth companies. Small cap companies up 11.5%, and large value companies up 14.4% as a whole. If we drill down in the fourth quarter, it is the same story. Small cap companies basically were flat, large value companies down 2% actually, but large growth companies up about 7%. Really led by, again, those technology companies that are the large ones that really led the way. Turning to international stocks, and this would again be developed market stocks, so Europe, Japan, Canada, Australia. These companies, the large companies, outpaced their small counterparts by about 2% there. And large value companies, in this instance, actually outperformed their large growth counterparts. So those large value companies up about 8%, whereas the large growth companies only up a little bit less than 3% over the course of the year. If we look at the fourth quarter, all of them struggled. The large companies, the small companies, the large value companies, the large growth companies, all of them went down close to the same amount, really, when we look at it. And again, in large part driven by the concern that the U.S. may be imposing tariffs and we could end up in a tariff war there, the conditions for trade being a chief concern there. So large companies down about 7.5%, small companies down even a little bit more. Large value were protected a little bit more, but large growth, again, down about 8.5% there. Turning to fixed income and drilling down a little bit more there, you could again see in 2024, the U.S. aggregate fixed income rate of return was 1.3%. Now, with the yield close to 5% on that, you would have to anticipate that the price of an average bond dropped during the course of the year because interest rates rose. And we'll dive into that a little bit more later on. You can see U.S. Treasuries did even more poorly than the aggregate fixed income market, down or just up about 0.6%. Treasury inflation protected securities were up a little bit more than their aggregate fixed income counterparts, simply because inflation persisted a little bit more than people anticipated. And the Treasury inflation protected securities, again, do a little bit better when inflation persists a little bit higher than maybe what was anticipated. You can see short treasuries were up about 4.5%. No surprise there because they're not as influenced by interest rates. And so if their yield at the beginning of the year is about 4.5%, then even the movements in treasury bond yields don't have that much impact on them. By contrast, the long-term treasuries are really driven in large part by the movement in interest rates in terms of their returns year to year. So they may have a 4.5% or 5% yield, but if the 30-year Treasury bond moves up or down 1% in terms of its yield to maturity, that's going to have a really, really big impact on the price. And you can see that they are down 7.7% over the course of the year, those U.S. long-term Treasury bonds. High yield corporates up about 8%. So they were the leader among kind of those bonds in the United States, these different categories that we'd say that would be fixed income in a classic sense. The yield on those far higher, and there was a spread compression there. So that helped and was a tailwind. Again, those bonds up about 8%. Corporate bonds have a little bit richer yield than their U.S. Treasury counterparts, and so they were up about 2% over the course of the year. And it's like we said, municipal bonds up just north of 1%. Global reinsurance doesn't track specifically with bonds. There are some different components there, of course, on the reinsurance side of things, but they are fixed income in some ways, in that there is a collateral component and there is a yield based on that. So you can see there had a really nice year, again, up over 17%. If we look at the fourth quarter, and this is where things got really dicey, I think, as interest rates rose, the fixed income market had a performance over the first 3 quarters of the year to the end of September that was kind of in line with its yield. What we saw in the fourth quarter, of course, were yields stepping up on all of the U.S. Treasuries, really from about 2 years and beyond there. So the 5, 10, 20, 30-year Treasury bonds, their yields went up in the fourth quarter. You can see that drove a drop in the performance there, down about 3% for both the aggregate and Treasuries, down almost the same amount for TIPS. As we mentioned earlier, short Treasuries really don't have that much influence from the overall movement in interest rates. They were flat. U.S. long-term Treasuries, though, really took it on the chin. They had been up a couple of percentage points heading into the fourth quarter, and then were down 9.5% in the fourth quarter alone. You can see that U.S. corporates and municipals were also hit, but global reinsurance, again, a different kind of investment there, was up about 3.8%. Doesn't perfectly track, again, with those fixed income returns, but posted a nice number there. And this is what I was alluding to, the U.S. Treasury yield curve. When we look at it at the end of 2023, you could see the line in gray there indicates that the shorter Treasuries were at a much higher yield back then, about 5.5% there at the end of 2023. That number, of course, dropped substantially. That 1 month number dropped over 1%, dropped 1.2% from the end of 2023 to the end of 2024. At the same time, what you would see is that anything that was on the longer side, intermediate or longer side of things in terms of maturity, actually increased. So from 1 month to 1 year, those yields were dropping, whereas from 1 year, really 2 years and beyond, the 3, 5, 7, 10, 20, and 30-year Treasuries all saw their yields increase. So now we have an upward sloping yield curve, which is what would be more typical. Usually investors require a higher yield when their maturity date is longer, because there's a higher level of uncertainty with a 30-year Treasury bond, for instance, with the credit quality of the United States government, than there is for a 3-month Treasury bond, where we could say with a high level of certainty that the U.S. is going to come through on its debt over the next 3 months. If we keep running a deficit over the next 30 years, there'll be a reckoning at some point. You can see in a very pronounced way, actually, the fourth quarter was one where we saw a significant increase. Just in the span of 3 months there, you could see the 1 year going up about 18 basis points, the 30-year going up 64 basis points. So going up somewhere in most of these maturity dates, somewhere between 0.5% and 1%, which is a pretty significant move on the longer side of things. A rule of thumb would be for a 10-year Treasury bond, for every 1% that the Treasury bond goes up, you would see a loss in principal of 10%. And so, again, if the 10-year Treasury goes up 77 basis points, you'd see a loss in principal value there somewhere in that 7% range. So a pretty significant move there in terms of the price of Treasury bonds and the overall move. And we see that again across the entire spectrum there, where we came into the year with a downward sloping yield curve, which would often indicate a recession ahead. And we ended the year in 2024 with an upward sloping yield curve, which would indicate expansion, but also put some pressure on the total return of those fixed income investments. One of the questions that clients always ask is, well, how attractive is the stock market or the bond market compared to the recent history? And as we look at that, one of the ways that we do is via asset class valuations with a set of statistics known as Z-scores based on 25-year average valuation measures. And we can look at U.S. Treasuries, we can look at U.S. stocks, we can look at other kinds of securities based on their history, basically, from this type of calculation. If you look at it, you look at this and anything that is below the x-axis there, that black line, would mean that the security is attractive. It is cheap compared to history. Anything north of that would indicate that the security is expensive compared to history. And the figures there, the farther north, of course, the axis there, the more expensive it is. And these would be based on, again, standard deviations. So U.S. Treasuries started the year in 2024 as fairly attractive. Their Z-score was negative 0.85. They've become even more attractive. As we talked about, those yields increased, meaning that bonds are more attractive than they were at the start of the year. So it's down to negative 1.09 at this point. Municipal bonds experienced the same thing. They started off the year as a little bit attractive compared to their history, negative 0.1, but now they are negative 0.62. We see on the other side of things, really every asset class on the stock side of things became either a little bit less attractive or significantly less attractive. So you can see international developed equities started the year a little bit below their long-term average, so a little bit cheap compared to history, negative 0.36. They moved up to negative 0.2. So they became a little bit more rich in their valuation. They're still kind of in line with long-term averages. If we look at small cap stocks or value stocks or growth stocks or large stocks in the United States, you can see in each one of those circumstances, the value coming into the year was less than that going out of the year. So U.S. small cap companies came into the year at 0.14, so just a little bit more expensive than their history. Now they're a bit more expensive than that. You can see value equities and growth equities both increased substantially in terms of their Z-scores, and large cap equities are now at quite a rich number there compared to history. Right in the midst of that, you can see U.S. investment grade bonds. And the caveat here is that this really only looks at the spread of the bonds relative to U.S. Treasuries. So we look at U.S. investment grade bonds, and both coming into the year and then going out of the year, you could see that they're a little bit rich. What that basically means is, let's just say that Apple bonds historically trade at 1% at a level where they're going to have a yield that's 1% over U.S. Treasuries, because Apple, even though it's a strong company, can't go down to the basement and print money to pay off its debt, whereas the U.S. government can do so if they needed to in a pinch. What we look at is those investment grade bonds, the spread, that is the yield pickup above and beyond U.S. Treasuries, is a little bit less than what we would see on average historically. So let's just say highly rated companies that are A-rated companies, let's just say that their long-term average is a certain amount. The spread there is a little bit less than that long-term average. The yield in addition to U.S. Treasuries is not quite as robust as it would typically be. So all in all, stocks a little bit expensive compared to history. U.S. Treasury bonds looking fairly attractive in terms of their valuation. And then investment grade bonds relative to Treasuries, maybe not quite as attractive, but again, relative to a long-term yield level compared to stocks, again, fairly attractive. So with that recap of the bond and stock market performance, I want to turn things over to Austin to talk us through how we measure the health of an economy and where we see the United States right now.
Thanks, Spencer. So to start off with this question of how do you measure the health of the economy, we're going to turn to Thomas Sowell, who says, the most basic question is not what is best, but who shall decide what is best. And I think the reality of when we think about the economy, whether you're hearing about what the economy is doing in the news, whether you're hearing about it from friends, there's always going to be a story that someone tells. And the story that they tell can often reflect the viewpoint that they think is true. And so what we want to do is we want to take a step back and we want to start asking those questions of what is the underlying data? What does that say about the health of any economy? And to do that, we're going to consider a couple different areas. We're first going to consider the federal government. We're also going to consider how do businesses respond? How do individuals react to those business and the government response? And then we'll come back and finish off with a little bit more understanding of where the US government is now in relation to the economy. And so to start off with, we want to look at the year-over-year change in the consumer price index between January 1st, 2000 and November 30th of 2024. With many of these indicators, whereas we have up-to-date information for the stock and bond market as of the close of business the day prior, for a lot of these indicators for the economy, it's based on when the US government decides that they're going to release any of their data. And so all of that will say some of these data points are going to be from September 30th. Some of them are going to be from the end of the year. So if we look at the consumer price index, this is the track of inflation. So this is CPI-U, the consumer price index for all urban consumers, all items in the USA. And this is an average statistic. And so as we look at it, we see from 2000 to 2010, the inflation rate, it went up and down, sometimes being high, up near 4%, but there were also deflationary periods right after the great financial crisis. The annualized rate there was about 2.8%, right about that Federal Reserve target or the Fed's target for inflation. We look from 2010 to 2019, inflation was not as hot as it was during the 2000s. On average, the annualized rate was about 1.9%. Now, if we tip forward to 2020, we have several drivers for what happened in inflation over those last couple of years. We think about the COVID crisis. We think about the money printing that happened post-COVID crisis. When you have a significant amount of turmoil that comes to an environment, and then a significant amount of money that is printed and pushed out into the government, into the hands of consumers, then there's going to become price imbalances. And so we think about things like the supply chain breaking and that money supply. And that's where inflation has really hit hard over the last 4 years. And so we look from 2020 to present, the average annualized rate of inflation has been about 4.6%. Now, that doesn't mean every year, but we see right after that money printing happened, that spike, and we really saw when the Social Security cost of living came out a couple of years ago, was close to 9%. And so inflation really peaked high, but we've seen it come back down, back closer to those more baseline numbers where we're wanting to see inflation over the long period of about 2.5%. Now, as we look at this from a cumulative standpoint, we take it again, those decades, 2000 to 2009, 2010 to 2019, and then 2020 to present. And we see what has actually happened with inflation. And what we see here is from 2000 to 2009, the consumer price index grew by about 27%. The next decade of 2010 to 2019, it grew by about 17%. Now, from 2020 to present, it's grown almost 30%. And so we've outpaced what inflation was in the 2000s and the 2010s already, and we're not halfway through this decade. So we really have to look, and we see inflation has really been hot, and it's been hot in a very fast manner. And again, like we say, we look at what happened right after the COVID pandemic started. And there was that significant amount of injection of money supply. That this is the growth of M2. And this is the injection, all of that money printing that happened for the stimulus of the economy. And those checks that went out to consumers, the drops of interest rates to, again, push resources into consumers' pockets. What that did is it really drove inflation hot. Now, we've pulled back the money supply a little bit, but we've kind of started growing that money supply once again. So again, if we look at this on these 3 decades, grew by about 83% in the early 2000s. Mid 2010s was 80%. We've almost gotten halfway there in those first 4 years from January 1 of 2020 until November 30th of 2024. So really have seen a pretty massive spike of money into the economy, or printed money into the economy, we should say. So shifting from some of those governmental interventions where money supply and inflation have to do with things, now we want to look and see what has the stock and bond market done during these same periods of time. And I think if we are really short-sighted and we look at what the stock market has done over the last 5-10 years, we can say, hey, stocks are always a great investment. They're always going to outpace bonds. But as we look back over these last 25 years, we can see there was a period where the reality was from 2000 up until almost 2017 or so, the bond market outperformed the stock market. And we look at this and we say, yes, stocks have done really well. If you want a long-term rate of return over decades and decades, it is likely a better choice to be a stock investor. But just like in the early 2000s, where we did not know that there was going to be a tech bubble bursting, and then we didn't know that there was going to be a terrorist attack on our country, and then we also didn't know that Enron and WorldCom were going to crash, and that triple whammy in the early 2000s that really took the stock market down. And then right as we were recovering, we had the global financial crisis that again took the stock market down. So if you were a bond investor from 2000 to 2010 or 2009, you would have been up about 84%. If you were a stock investor in that same period of time, you would have been down about 2%, which is inverse what we see over the last 15 years. And that's from 2010 to 2019, bonds were up 44.5%, whereas stocks gave us a rate of return from 2010 to 2019 of about 250%. And so we see the growth potential in stocks is significantly higher, but there's also periods of time where you may be underwater for quite a while with stocks, especially if we're taking multiple hits and they're coming at intervals apart. We look in 2020 to present, and with that money printing, then the subsequent time where interest rates rose over when we saw that in 2022, bonds have really gotten hit pretty hard so far this decade. From 2020 till now, down about 1.5%, where stocks, on the other hand, are up 91.5%. And this is where we really would come back over and again to say, let's always look to be well-diversified investors that are taking a very long approach, where we can't say it's always going to be better if you're in stocks. It's always going to be better if you're in bonds. There's going to be times where stocks outperform. There's going to be times when bonds outperform. There's going to be times when alternatives outperform. But that's why we take a well-diversified approach to investing. And so really what we're seeing here is that there's going to be certain areas and certain times where businesses do well in lending. There's going to be certain times when businesses do well in growing their company's bottom line. But we want to always take this in aggregate and look back to history as we're making decisions about where to go in the future. So we come back and we look in and ask the question of what is the U.S. gross domestic product? What are all those factors that influence the growth of the total U.S. economy? And we look over the last 30 years and say from 2000 to 2009, the economy grew at about an annualized rate of 1.9% per year. From 2010 to 2019, it was about 2.7% per year. And then so far this decade, from 2020 on, it's been about 2.4%. Now, I think when we hear GDP, often I would used to assume, before really understanding what GDP is that maybe the government has a lot to do with GDP. Well, the reality, though, is if you look at the percent of contribution of U.S. GDP, whether that's from the government perspective or private industry perspective, and this is from January 1st of 2006 to September 30th, just the area where we have the data. So if we look at the current allocation, almost 90% of GDP comes from private industry. Only about 11% of that comes from the federal government. And when we think about how does the economy grow, we really want private industry to be the primary driver of how our economy is doing, where it's growing. If the US is doing well, we think we want We want businesses to be doing well. We don't want to have a lot of the economy driven and controlled by the federal government. And as we can see, the contribution to GDP is largely by private industry. Those businesses, the places where we work, where we contribute, the jobs that we have, the income that we receive, a lot of that is driven by US private industry. And so continue to think about, how is the economy doing? Well, if businesses continue to do well, our economy will continue to grow. That shows health of the economy. So let's take a turn now and look and see how consumers have been impacted. And so what we've got here is the year-over-year difference between disposable income, so the income that consumers have in their pockets to spend on goods and services. So the difference between that income minus the year-over-year change in inflation. So essentially just saying, okay, as incomes rise, is inflation outpacing the pace of our income? So the times where the line is above that zero baseline are times where income, disposable income in the pockets of consumers, has outpaced inflation. Now, as we see here in the early 2020s, there were a couple years where inflation ran really hot and income did not match that pace of inflation. And so those were years there where we would felt a tightening of our pocketbook. There's not as much money that we can spend because now goods and services are more expensive than the amount of income that we have received as a year-over-year change. And so now, though, we're seeing, now that we've kind of moved past that first hot spike of inflation, income has continued to rise, inflation has continued to cool down. And so there are areas in the economy where we are now able to make sure that we are saving, putting money aside. And on aggregate, again, these numbers are on aggregate, we look at the cumulative difference between 2000 and 2009. And that cumulative difference was about 27%. The cumulative difference in the 2010s was about 29%. And up to now in the 2020s was about 10%. And so again, we see that the US consumer, while stories may be online that there are certain subsets of the society and of our economy, that there are individuals that are hurting. We recognize that rent is expensive, that there are food that is expensive. But the reality is we're coming back to a place of a little bit more normalcy where income, the growth of income, is outpacing inflation. But one area where we see that this is really pronounced, inflation is really pronounced, is the cumulative growth of changed CPI of food between January 1 of 2010 and November of 2024. And so we look and we see, if you go to the grocery store, I can guarantee you this is one of those areas where you have continued to see your bill climb over and over and over, because we have not entered a deflationary period. There are very few times over the last 25 years where we've actually entered a deflationary period where prices drop. And so food is one of those where, if we look at from 2010 to 2019, the cumulative growth in the cost of food was about 17%. From 2020 till today, it's been about 28%. And so we've seen the cost of food rise at about a 6% per year basis. And that's something that, unless we see a dramatic deflationary place, that the prices of food are going to remain at an elevated level. And what that means is, the reason we use chain CPI here is because chain CPI, what it does is it allows for substitutionary changes. And so if I see the price of beef go up and the price of chicken go down, then I would be maybe more inclined to buy the chicken. If I see the price of apples go up and oranges go down, I'll buy less apples and buy more oranges. So we think about chain CPI here for food because it's really that substitutionary. When we go to the grocery store, if we see something that we normally buy as expensive, we might buy something a little bit cheaper. But even in that regard, we've seen the price of food really skyrocket. And so as we think about the US consumer and how they have been impacted by inflation, how they've been impacted by some of these areas of the economy really growing at a quick pace, food is one of those where it really starts to see, where we start to see some of that pain. So rounding back out our conversation on the economy, and this comes back to this interest rate conversation that Spencer was talking about. As interest rates rise, if the US government continues to loan 30-year Treasury bills or Treasury bonds out at a 4 or 5% rate, then what the government has to do is that annual interest that we have to pay, that the government has to pay, continues to increase. And so you can see now that the annual interest due on the US debt at the end of last fiscal year was close to a little bit over $1 trillion. So that means every year the US government needs to pay about $1 trillion in interest payments. And so we've seen that rise as interest rates have risen. And so we look from 2000 to 2009, that was about $36 billion was the median annual interest due. From 2010 to 2019, it was about $430 billion of annual interest due. From 2020 to present, that median was about $720 billion. And so as those interest rates continue to be high, the federal government is going to continue to have to pay interest at that higher rate. And so as investors, as folks that are impacted by the economy, as we think about tax planning, as we think about how do we really live in this world where the US government has a significant amount of debt and they have a significant amount of interest due, we don't know where taxes will head in the future, but we look at this and we say, that's a lot of interest that the US government has to pay. And taxes are historically low. We don't know where taxes are headed, but the reality is we've got a reckoning coming up of if we continue to run this deficit, if we continue to have high interest on those loans that the US government makes, then there is going to be something that has to give in the future. And so we look at this from a debt to GDP ratio, the US debt as a factor of GDP. In the early 2000s, it was about 60% of our GDP was public debt. If we look at it now, 2010 to 2019 was almost equal. But then now, 2020 to present, it's about 120% is our US debt to GDP ratio. So we really are starting to see that debt level rise in ways that are becoming really concerning in a lot of regards for both investors. And this is why we start seeing some of that pressure be put on some of those fixed income resources, where we start asking the questions of how does the US handle this debt problem that we have, this interest rate problem, this interest problem that we have as we continue to loan out money. So the question then becomes, how do we respond? Well, one, we have to remember the economy is complex. We have businesses that are doing well. And then because businesses are doing well, stock investors are rewarded. We also see then that incomes rise. The job market has low unemployment. We see that then consumers are paid as they go to work and their wages continue to increase. But the economy is complex. With that, we also have high interest rates and high interest payments from the federal government. We want to also think about avoiding news sources that only drive fear. If all you've heard over the last 5-10 years is the US economy is doing terrible, well, maybe we need to actually look and see, man, the economy has actually done pretty well over the last several years. And if all you're hearing is fear, but the reality is maybe the economy isn't in that bad of a place, maybe you should question the news sources that you're listening to. And finally, it's always wise to ask a lot of questions and be able to find some answers. There's not going to be an answer for every question that you may have, but if we ask a lot of questions, we might find some of those answers. And with that, we want to say thanks again for tuning into our State of the Markets. As always, all of our advisory services are offered through Retirement Planning Services, LLC. Any of the past performance from either the stocks, bonds, or economic indicators doesn't indicate future results. All of the indices that we referred to are unmanaged and cannot be invested into directly. Thanks for tuning in, and we'll see you again next time.
If you like these financial planning videos, please share with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.